You know how everyone's always looking for that next big catalyst to kick off a market rally? But what if it's not some future event we're all waiting for? What if it's already here, working away in the background, completely in secret? Let's dig in.
So here's the big question we're tackling. We're diving deep into an analysis that says the Federal Reserve has already fired up the money printer again. But they've done it so quietly that almost no one has noticed.
And what's the number? Get this, $40 billion. According to our source material, that's how much new cash is secretly being pumped into the system every single month. So, you gotta ask, where's it coming from? And why is nobody talking about it?
Okay, so to really unpack this whole thing, we've got to go back to what looked like a totally normal day on the calendar, an event that might have been the perfect cover.
So picture this, December 10th, 2025. It's just another one of the Fed's big monthly meetings. Nothing seemed out of the ordinary. You had Fed Chair Jerome Powell up at the podium, doing his thing, going through all the usual economic updates.
So on one hand, Powell was talking about all the usual stuff, interest rates, inflation goals, what the economy is looking like. But what he didn't talk about, well, that's the real story here. He completely left out a massive, brand new $40 billion program. The biggest news of the day was the news that was never announced.
So where did this info finally pop up? It was literally buried in a press release, and not even from the main Federal Reserve, but from the New York Fed, a regional branch. The analysis we're breaking down here argues this was totally on purpose. No big fanfare, no press conference. The whole point seems to be to keep it on the down low.
So what is this program really? Is it just some boring technical move that nobody needs to worry about? Or is it something a lot bigger?
The official name for it is Reserve Management Purchases, or RMP. And yeah, I know it sounds super technical and frankly kind of boring. The official line is that the Fed is just buying some short-term government debt to make sure the financial system's plumbing is working smoothly.
And this is where the Fed can get technical and say, hey, this isn't QE. They can point out that RMP buys short-term bills, not long-term bonds, that it targets a different part of the financial system, and that the official goal is different. But, and this is a huge but, the analysis we're looking at says that's all just fancy footwork.
And that brings us right to the heart of the argument from macro analyst Arthur Hayes. He just cuts right through all the noise and says, look, if it walks like a duck and talks like a duck, it's probably quantitative easing. It's money printing.
Let's just break that down real simple. The government needs money, so it issues debt. Then the Fed creates new money, poof, out of thin air, to buy that debt. So the government gets its cash and all these new dollars start sloshing around the financial system. And where does that money go? It hunts for a home. And that home is usually assets like stocks, pushing prices way.
Okay, so that begs the question, right? If this is a tool to boost the economy, why hide it? Why tuck it away in some obscure press release? Why be so secretive?
Well, the analysis lays out this really clear step-by-step logic. First, our economy is completely tied to the financial markets. For pensions, 401ks, and just general good vibes to work, the stock market has to go up. Second, QE is the best tool they have to make that happen. But here's the problem. The public absolutely hates the term QE now. They hear it and they just think inflation. So, what's the solution? You do QE, but you give it a new, boring name that no one will notice.
And this quote from the source material just nails it. The brand QE is toxic. People feel the pain of rising prices every single day, and they'll vote against anyone they think is responsible. So the name had to go.
So let's connect the dots here. Because this isn't just about economics, right? The timing of it all points to a very specific political playbook, aimed squarely at the next big election.
So here's the game plan, according to this theory. You start pumping liquidity into the system about a year before the midterms. That makes stock portfolios look great, makes people feel wealthier, and they feel better about the economy. Meanwhile, you publicly talk tough on inflation, but behind the scenes, you're printing money. And if prices do creep up, you just blame it on something else.
According to the source, this kind of strategy is tailor-made for a leader who's more of a pragmatist than an ideologue. The logic is pretty simple. Rising markets and stimulus are a proven way to win votes. It's a formula that's been used before, and it works.
All right, so if this whole theory holds water, what does that actually mean for the markets in the coming year? Well, the analysis lays out a really interesting roadmap.
The prediction goes something like this. Early 2026, markets start feeling good as all this new cash finds a home. But then, we might hit a little bump around March. See, the program was called temporary, so markets are going to get nervous that the party's about to end. That could trigger a dip, but then the Fed will step in, calm everyone down, and that's when, according to the analysis, it's off to the races right into the election season.
And this, right here,
is the key to the whole thing. The reason we haven't seen a massive rally yet is because most people are still in the dark. It's just like back in 2009. It took the market a while to figure out just how powerful QE was. The same thing could be happening right now. The money printer is on, but most people haven't heard it yet.
So that's the multi-billion-dollar question we're left with. Is this super technical, kind of boring-sounding program actually the secret money printer in disguise? And could it be the hidden engine that powers the entire market through 2026? It is definitely something to think about.